Today, we're looking at the China narrative, regulatory FUD, the continued explosion of perpetual trading DEXes, new launches on Arbitrum, the best yields currently available in DeFi, and reviewing Coinbase newly launched Layer 2. Welcome to the third episode of the DeFi Weekly with One Click Crypto. Starting off with a high-level market overview, Bitcoin started this week at 24.2K and has made several attempts to flip the resistance at 25K. As we correctly called in our previous weekly update, this resistance level is quite strong historically, and it might be quite difficult for Bitcoin to push through. But it still continues to set higher lows, which is quite good. The fact that the market has not reacted negatively to the regulatory FUD and the Operation Choke Point 2.0 seems to signal solid underlying strength. ETH started this week at 1,680 US dollars and continues to push against the resistance at 1,700. This level functioned as critical support during the summer crash of 2021 and is now proving to be really stubborn as a resistance. Yet ETH remains in an uptrend since the macro lows in June. And given that more than 30,000 ETH has been burned since the merge last year and became deflationary, the tokenomics look stronger than ever. The total market cap of crypto rests comfortably above the 1 trillion US dollars figure, and in early January broke above the 200-day moving average, signaling medium-term bullish momentum. Talking China, GCR Classic adopted this thesis publicly on Twitter in early January, and it was recently echoed by Cameron Winklevoss, co-founder of Gemini, when talking broadly about the administrative crackdowns from United States regulators. These findings first started gaining traction when Chainalysis released its report showing rampant adoption of crypto, specifically in Southeast Asia, in late 2022. Crypto Twitter figure Miles released a list of Chinese coins he was watching, and since his tweet on February 18, nearly all of the mentioned coins are up significantly. As we can see, some of them had gotten more than 700% return over the last 30 days. But the bigger question is this the short-term narrative rotation play, or will this become one of the defining narratives for 2023? Chain Debrief highlighted the huge capital injection from China's central bank, showing that China wants its financial apparatus well lubricated with liquidity. The real catalysts will occur in June when the trading of crypto assets becomes finally legal in Hong Kong, and this might be a tender first step for greater crypto adoption in mainland China. In short, China has the money printer turned on, the regulatory approach is now getting softer, and crypto has a much better public image in Asia without such massive scandals of fraud like the recent SBF FTX scandal. So maybe it's a good time to start learning Mandarin. Nick Carter released a fantastic blog post earlier this month highlighting the ongoing and coordinated regulatory attack from the government bodies seeking to cut crypto off from banking. Recently, Kraken has stopped offering its staking service for the US retail, and Paxos has stopped issuing BUSD stablecoin, essentially meaning BUSD has become a legacy project and the total supply will only decline. As we reviewed in our previous weekly episode. It looks like Gary Gensler wants to continue this campaign, which looks like a copy of the strategy used by the Obama administration a while ago to kill online gambling. Gensler seeks to choke crypto off from financial services altogether, and unfortunately, this might mean and this could lead to services, products, and talented developers driving away from the United States. Arbitrum is the hottest chain for all DeFi activity, and it continues to absorb liquidity more than any other chain. This layer 2 scaling solution benefits from Ethereum security guarantees and gives the Ethereum experience in hyperspeed at a fraction of the cost. Arbitrum still has no token, and this has pushed a lot of speculative appetite into the ecosystem. Crypto traders have a massive appetite for leverage, and the continuing growth of exchanges focusing on perpetual futures shows this quite clearly. JMX has been the father of all perps on Arbitrum, but the data shows it's actually losing momentum. Vela launched its beta in February and has already eclipsed the total trading volume of GMX. The 24-hour volume of GMX has been roughly 150 million on Arbitrum, and on Vela it's more than 250. VLP is the liquidity token for the Vela Exchange and can be minted using USDC. Currently, it offers a yield of actually more than 83% APR and a very, very attractive rate for stablecoin yield. Vela, the utility token of the exchange, has made an impressive rally this year, but it looks a little bit frothy at the moment, and it would make sense to wait for a proper retracement before making an entry if you are bullish on this token. Another perp DEX on Arbitrum is RageTrade, and it has been performing quite well, and also offers a range of vaults to investors, and there are a couple of offerings such as a risk off and risk on vault. Risk off basically allows users to deposit USDC to be used as collateral on Aave, earning supply APR and a portion of ETH rewards from GMX. And risk on vault allows users to earn yield on GLP while neutralizing ETH and BTC price exposure. Both vaults have reached their full capacity at the moment, and offering right now 8.2% and 6.5%, but the yields are quite variable. Yesterday, they had been offering 12 and 28% respectively. So please use your own judgment when deciding whether it makes to invest in the products like this. Other more nuanced trading products on Arbitrum also gained quite some popularity, such as Y2K Finance, which allows traders to speculate on depegging events. So essentially, you can select an asset and select a strike price for its potential depeg, and there are a bunch of vaults and farms for DAI depeg, ROB BTC depeg, USDD depeg, etc. Overall, Arbitrum features a really impressive suite of financial dApps that are steadily growing more complex and opening the possibility to find new and exciting yields. New launches on Arbitrum. So all the largest launches within Arbitrum are happening on Camelot DEX, which is slowly becoming the front page of the ecosystem. The native token of Camelot Grail It recently did a 10x, and the DEX has attracted an impressive amount of liquidity and volume, both spiking in all-time highs. Given that Grail can be converted to X-Grail and used to collect a percentage of the platform earnings, Grail could feasibly continue its rally. Two biggest launches that drew attention recently were FactorDAO and TROVE. TROVE is the governance protocol for Arbitrove, which will be an index and strategy vault bringing together all the up-and-coming blue chips of the Arbitrum ecosystem, such as JMX, Magic, and Grail. Trove has raised more than 8 million US dollars in ETH in its pre-sale. However, there were concerns when devs removed the hard cap limit for the sale, and perhaps they got a little bit too greedy. Trove was claimable on the 21st of February, Tuesday this week, and has been in free fall since. FactorDAO opened the sale for FCTR token, an asset. Factor is basically an asset management protocol that provides the tools for users to create their decentralized asset management vaults. Factor will be convertible into V-Factor, and V-Factor token holders will receive 50% of all platform fees. However, the ongoing pre-sale has caused plenty of controversy. FactorDAO employed a fair launch open sale beginning on February 20th and closing on February 24th, where 10 million Factor tokens will be sold. The final price for the total amount raised is divided by 10 million Factor tokens, and all participants will receive an identical final price. With no incentive to buy early and the 4-day sale, the real question becomes what will happen to Factor post-launch. Currently, we're still running the active sale with 5 hours, 30 minutes left, and the total amount raised being almost 7 million US dollars, which marks the Factor price at almost 70 cents. This sale mechanism heavily favors the developers at the expense of investors, and the Twitter user Jack Inabinet wrote a great article on why he would not be participating in the sale. So will Factor follow in the downward footsteps of Trove? We can see it already very soon. Let's look at some of the best yields of the week. Remember the two core rules of DeFi. The first one, move fast, and two, don't be slow. The yields of the week will likely be different next week, but DeFi rewards those who leverage its inefficiencies well. Stablecoins. Several Beefy vaults are paying out high single-digit APRs on Beefy thanks to the auto-compounding vaults. Most of these yields come from Stargate, a native asset bridge built on layer 0. Beefy takes the liquidity incentive token STG, swaps it into stable, and loops the process. Single-digit APYs on stablecoins like USDT are very attractive, and this type of yield will eventually converge with the rates available in TradFi, the bonus of being a relatively early participant in DeFi. For people wanting to generate yield on their ETH, Pendle, a new protocol on Ethereum, has several pools offering APYs in excess of 30% with varying maturity dates. Pendle is a DeFi protocol that splits yield-bearing assets into two parts, principal and yield, allowing more intricate yield management strategies. Those who deposit assets into Pendle's pool receive swap fees, Pendle incentives, and incentives emitted by the underlying asset. Pendle also allows users to buy yield-bearing assets at a certain discount. However, all of these products have maturity dates where the deposit becomes fully redeemable. So investors who try to offload their assets before the maturity will likely have to sell at a much discounted price. But Pendle is undoubtedly one of the interesting protocols. If we were to talk about more degenerate yield, a more bullish market sentiment means a spike in trading volumes, and given the automated market maker model that powers most of the trading in DeFi, it means plenty of swap fees for liquidity providers. And as you can see, there are plenty of pools offering APYs 5 and 6 digit yields. Those who were in DeFi in 2020 and 2021 will remember seeing these outrageous APYs. However, the reality is, for most of these pairings, the impermanent loss will destroy any gains from trading fees. If you want to enter these pools, first find a token where you like the underlying asset and enter that pool. An example would be RDNT ETH. RDNT is the native token of Radiant, a lending protocol on Arbitrum, which is rapidly growing. And the pool offers an incredible APY of 186%. RDNT can be staked on Radiant for percentage of the protocol earnings, and Radiant has currently paid out more than $5 million to RDNT stakers on the platform. To summarize, the China narrative seems very real indeed, and following liquidity always pays dividends. Investors should keep an eye on the development of this China narrative story. For the first time ever, Arbitrum executed more transactions than Ethereum Layer 1, making a huge milestone. And you have probably already realized how heavily Arbitrum has been featured in this episode. Arbitrum really is the DeFi hotspot at the moment, and most of the liquidity being deployed in DeFi heads straight to Arbitrum 1. Nobody knows when Arbitrum will release a token, but the wealth effect of the ARB token will likely be insane. And even though there has been no confirmation of an airdrop, users already active on the network increase their chances of receiving tokens if the team decides to do an airdrop. Finally, just yesterday, Coinbase announced Base, an Ethereum Layer 2 scaling solution using Optimism Stack, which is open source, allowing anyone to spin up a Layer 2 and essentially brings the modularity app chain thesis to Ethereum. Base will be an execution module relying on Ethereum's security guarantees, and this marks the start of an interoperable super chain with all Layer 2 scaling solutions built using the OP stack being fully interoperable. Base will help onboard the next billion users into the crypto economy and highlights Coinbase and Brian Armstrong's commitment to decentralization. So that is all for this week, folks, and thank you for joining. I hope to see you next week. Remember to stay safe, consider impermanent loss, and always ape responsibly.